Well, we've had basically a 20-year bull market, maybe more than that. That'd be 2 or 3 years. I'm thinking about 3. We've already started it maybe 6 months ago. So again, it's not a perfect science. So my take is we're going to see the biggest moves ahead of us, meaning rapid appreciation within 2-3 years, and expectations probably in the $1,000 gold, meaning like 4, 5, 6. I don't think we're seeing 10, but people think we could get to 20. I could make that argument. And then silver, I said, 2003, we see triple digit silver, and I still believe that.
David Morgan is a silver investment expert and monetary analyst who predicts that the most significant price moves in precious metals are yet to come, with gold potentially doubling or tripling from its $2,000 breakout to reach $4,000 to $6,000 within 2 to 3 years. He also reaffirms his long-standing forecast for triple-digit silver, a call he first made in 2003. Gold has delivered a stunning performance since the beginning of 2024, surging from around $2,000 per ounce to where it sits today at over $3,400 per ounce. The precious metal shattered multiple price records along the way, including breaking through the key $3,000 barrier for the first time in history. If gold matches last year's percentage gains, reaching $4,000 in 2025 appears well within reach. This aligns with Morgan's outlook and supports the view that silver will reach $50 an ounce in 2025 and hit $77 before 2028. These estimates are based on 50-year price trends, inflation expectations, and the current gold price. When gold does well, silver tends to perform well too. David Morgan says the gold-silver ratio could return to 33 to 1 or settle near 40 to 1. But levels like 16 to 1 or 10 to 1 would depend more on sentiment than fundamentals. The gold-to-silver ratio is 90.8. In recent decades, the ratio has typically fluctuated between 40 to 1 and 80 to 1. Market veterans generally view anything above 80:1 as signaling that silver is undervalued compared to gold. In contrast, readings below 40:1 suggest the opposite. Before we dive into the video, please take a moment to like and share it. Thanks to your support, we've reached 1,000 subscribers. Let's keep pushing for even greater heights, so don't forget to subscribe. Your support means a lot to us.
Talked a while back about the confirmation idea in the metals. In other words, you got to have confirmation of gold's move with the other metals, and we've had that now, especially platinum actually outperforming everybody year to date. So I'm very confident, and I was before the confirmation that we are in the next leg of a major bull market in the precious metals. Silver above 37 technically is very bullish, very strong, and silver could take off at any time. You never know. Silver can fool the best of us as far as wanting it to do something that it not performing the way you expect. But nonetheless, I think the trend is very clear. So even though the summer doldrums are here, the white metals seem to be doing quite well, as gold kind of just is going sideways more or less until we get through the $3,500 level. It's the Morgan rule, where we see it 3 days in a row above the breakout point on above average volume. Then I'd be convinced that we're on our way for further gains. So I still think we're going to go sideways in gold through the summer. August is usually the weakest month for the metals, but overall very bullish, very happy, very pleased. I think the markets are moving at a pace that causes excitement, but not so fast that people will have the fear of missing out and think that, it's only going to last another month or two, because that's not the case in my view. It's going to continue. There will be some very sharp corrections that will scare people, but nonetheless, the overall trend is pretty clear. I think that we're going to see the largest move could get a double from here. So you go from, 3,000, you could do the breakout. The first breakout really was $2,000 gold. We just couldn't seem to get above that ceiling. And then finally we did. We got above 2,000, went to 3,500, pretty short order. So you could take that 2,000 and you could double or triple it. You could say 4,000 to 6,000. And in time frame, 90% and 10%. What does that mean? Well, we've had basically a 20-year bull market, maybe more than that. That'd be 2 or 3 years. I'm thinking about 3. We've already started it maybe 6 months ago. So again, it's not a perfect science. So my take is we're going to see the biggest moves ahead of us, meaning rapid appreciation within 2-3 years, and expectations expectations probably in the $1,000 gold, meaning like 4, 5, 6. I don't think we're seeing 10, but people think we could get to 20. I could make that argument. And then silver, I said 2003 we see triple digit silver, and I still believe that. As far as where will the gold silver ratio be at the top, you didn't ask that question, but I've been thinking about it a lot lately. And the gold silver ratio in this bull market so far had a day or two at 33 to 1. And I think we'll get back there or close to it. So 40 to 1. I'm not so sure that we'll get to 16 to 1 or 10 to 1 that I wrote about way back in 2002 or 3. We could. It really just depends on market sentiment more than anything else, where we go. So higher, yes. When? I'll be vague. 2 to 3 years. Prices, I'll be vague. Triple digit silver and then multiple thousands for gold.
David Morgan emphasizes that gold prices remain driven by core macroeconomic forces, liquidity, central bank demand, inflation, and overall market conditions, just as they were before the implementation of Basel III. While the reform might theoretically lead banks to hold more physical gold, David Morgan notes that its actual impact remains uncertain. Gold's price continues to be shaped by reserve accumulation and sustained purchasing activity. In 2024, around 1,136 tons were added, a 15% year-over-year increase, driving strong institutional interest and steady upward momentum. This pattern remains firmly in place as 2025 unfolds. With core inflation currently at 3.4%, concerns about currency devaluation persist, driving investment in precious metals. Gold's millennia-long history as a store of value during periods of inflationary monetary expansion reinforces its appeal when purchasing power is threatened. These fundamental forces reinforce Morgan's bullish outlook as aggressive central bank buying, ongoing concerns about inflation, and rising institutional demand all contribute to strong support for gold's continued rise. Let's get back to the video.
A lot of commentators, some Kitcos, some on LinkedIn and other places talk about, the tier 1 aspect of Basel III. And I think Basel III is kind of overblown. I go back to the old market adage, buying the rumor, selling the news. The rumor's been out for a very long time, lots of commentary about it. And now the news is out there. It's enacted. So these analysts argue that Basel III is a bookkeeping reform, not a catalyst for gold buying mandates. Gold price remains driven, and it's really not. So gold remains driven by liquidity, central bank buying, inflation, and macro factors. Those are the same drivers that were there before Basel III. The reform looks like it could be explosive to boost physical holdings by bank, but that's really uncertain. Really, it's reduced some of the trading desk and consolidated things, but I think it's a kind of a ho-hum at this point. I don't agree. Gold remains a tier 1 asset, which is bullish, not bearish. In effect, it's a gradual structural shift, not an overnight shock. Gold prices, again, remain tied to the gold liquidity, real yields, supply-demand fundamentals, and central bank policy. So it's not a no-brainer, but it's certainly not, I think, needs to be as hyped up as some others have said. If you had a 1930-style stock market crash where it was over an extended period of time and really couldn't, get off the map for quite some time, as a metaphor, that would be so devastating to not only the United States and all the entities I named, but on a global basis as well. So I think there's a lot of power and emphasis to continue to provide the stock market with whatever liquidity is needed to keep it at a rather high level. They may not continue to move it higher and higher in real terms, because if you look at the stock market in terms of the stock market priced in gold, it peaked in the year 2000. That's 25 years ago. And that's the basis of one of these books back here called The Invisible Crash. Gold is a constant. An ounce of gold is the same mass anywhere in the universe. It doesn't change. So if you use that as the constant, you plot the S&P 500 against it or the Dow, you'll find actually they've been in a downtrend against gold. And I was looking at the dollar chart before we connected this morning, and it looks to me like we're on our way to maybe 9 91 or so in fairly short order. I mean, the administration wants us cheaper dollar. I mean, basically any nation state wants their currency to be cheap because they get an advantage as far as an export advantage. So as Jim Dines used to call a race to the bottom, everybody's competing against everyone else to weaken their currency. And this is a very sad state of affairs, but the dollar certainly going that direction. And, if you look at a long-term chart, I mean, dollar, the Dixie's been down to, I think, 70 or something. Do it from memory. I just looked at a near-term chart before we call. But I do think that it's got more room to the downside, and it may mitigate some of the foreign exchange problems that other countries have paying back the U.S. in dollars, because if it weakens on the dollar index, that means those other currencies against it are increasing, because when you got to pay back dollars and they're more expensive in your currency, it makes it harder on these other nation states to pay back the dollar debt. So I'm always been concerned about, the dollar, because as we've said 100 times, it's it's the most stable currency out there, and it is the reserve currency, and it's the most depended on and most dependable on a global basis. But that's been shifting quite a bit the last few years. I mean, Andy Schechtman talks about it very, very often, as others do, that, the BRICS really interjecting peer-to-peer currencies. Without a BRICS currency per se, they are trading each other's currencies and circumventing the dollar altogether. And then with the OPEC nations, OPEC Plus, taking on other currencies to settle oil debts where oil transactions have been taking place. So the dollar is really being mitigated from its top role, which it still has, but less and less significantly. And I think that trend will continue, and I think you'll see a lower dollar as we go forward.
Gold and silver continue to gain momentum as underlying forces drive both metals higher. With gold breaking record levels and silver showing strong potential, the outlook remains firmly bullish. As market dynamics align with long-term trends, both metals appear well-positioned for meaningful gains in the years ahead. There is currently strong demand for gold and silver, which is contributing to rising prices. Gold is leading the rally, and the breakout to new all-time highs has removed key psychological resistance levels, opening the door for accelerated gains as new investors enter the market. The Federal Reserve's dot plot now projects 3 interest rate cuts through 2026, creating a favorable environment for non-yielding assets, such as precious metals. Both metals saw gains in 2024 and are continuing to rally in 2025, with further upside expected in 2026. A quarterly Reuters poll indicates that analysts and traders expect gold and silver to maintain their upward momentum into next year. Will gold and silver continue their rally into 2026 and deliver new all-time highs? Share your thoughts in the comments. And don't forget to subscribe and help us reach 2,000 subscribers. Only 2.3% have subscribed so far. Hit that button to stay updated with the latest insights.